Hello and welcome to BQ Prime. You're joining us on Bankable, where we talk to some of the leaders in the banking and financial services industry and try and understand a little bit about how they are viewing the market, the opportunities that they're seeing, as well as some of the threats that they're watching out for. Today, on this very special episode, I have with me Mr. Nirmal Jain, the founder and chairman of IIFL Group. Ms. Jain, welcome to this conversation. I want to first start with your current viewpoint on the lending market that exists. We've had a prolonged period of low interest rates after the COVID-19 pandemic. Now things are turning around. Things are becoming a little bit more expensive. Some early signs of stress in certain parts of the economy are showing up. But your overall view?
I think overall things are looking much better and we're a lot more optimistic than they were ever. So I don't know which parts of economy that you're referring to when you say there are some stress. There may be. And that will always be the case. But still, I would say that the segments or the proportion of the economy that is really booming at this point in time is one of the best or highest in my memory. And this is a cumulative impact of government has done for infrastructure on one hand and DBT and making sure that there are no leakages and money goes out to poor people and a lot of other reforms and things that have been put in place. So at this point in time, I think the economy is doing very well. Now coming to the interest, of course, interest rates have gone up. The bank base rates have gone up almost by 2.5%, which is not small. But relative to what has happened in the rest of the world, it is still affordable.
Yeah.
And I think that we should also remember that before 2018, interest rates were also at similar level. And the nominal incomes have gone up significantly. So people are able to afford. And that's why we don't see any stress which is caused by this interest rate spike that has happened. So interest rate going by 2.5% on a base of 9% is one thing, and interest rate going up from say 0 or 0.5% to 6% is completely different.
Correct.
Thing. And okay, having said that, if we see that in the housing market, like mortgages, affordable housing in last 2 quarters, it has slowed down or it has not grown to the expectations of most of the industry players, primarily because EMIs have become more expensive and rates have gone up.
Sure.
Now, the most likely scenario in India, inflation is under control, macro is in a very good shape, tax collection is going up. So there's no reason for interest rates to go up further. There'll be a pause. But as people say that it may be higher for longer. So it will be like an inverted U curve in the interest rate that we'll see. So it's not going to come down in a hurry.
Correct.
But even if they remain at these levels and people get used to it, things shouldn't be bad. The credit market still looks very strong.
Okay. And let me break this conversation up into economy, business, and IIFL specifically. Starting with the economy question. Now, you said that there's a lot working, and I had read one of your op-eds recently where you talked about this unstoppable sort of engine that is India. I want you to take us through what is at this point in time looking the most promising to you. From an economic point of view, what is looking as a potential business opportunity and for maybe for a long term, from a country point of view, what is looking good for you?
So from a country point of view, I think first time what we are seeing that China is slowing down and China is not looking good. So in terms of investment capital, China was a big competitor of India.
Yeah.
India is attracting a lot more capital for 2 reasons. One, as a destination outside US, a developed market, India is one of the most attractive. Within developed markets, as we know, Europe is also in a recessionary and slowdown, so you don't expect much investment there. China, people have got disillusioned because to my mind, China always had opaque policies and a lot of other problems. So China's problems are getting compounded. One is the geopolitical tension and the second is the demographics. For India, demography is a boom. I mean, it's something which is absolutely working for us in an amazing way. And for China, it's a disaster because they had one-child policy. I mean, if you use that math, then their population may halve.
Correct.
That means the local market may halve for most of the commodities because, what was China doing for so many years, for last 3 decades, is that they were using the scale of local market to be very competitive and dump the goods in export market. And then get more scale for a virtuous cycle of low cost and bigger scale.
Yeah.
And that basically crowds out most of the players in the world because they become dominant. Because nobody can compete with them in prices because they got scale and they build on that scale. Now I think this cycle is reverse. One, given the way they operate, most people, despite higher cost, would like to have an alternative. And many MNCs are now very seriously looking at alternative, which can be India, can be Philippines, can be Vietnam, but they're looking at. However difficult it is, because China is so big, it's not easy to create or have an alternative overnight, but still. And two, China slowing down, and their mortgage market can be a bigger problem because they have more houses than what they need already. And if, a country where there's 4 grandparents, 2 parents, 1 child, no cousin, no uncle, is a very precarious in terms of the way the market and the economy will go for the next few. So I think India's big advantage now, which was never there before since independence, is that the China, which is a very large economy, is for multiple reasons not in a good shape and not a good destination for capital. And on top of that, fortunately for last, in these 2 terms of this government, reforms, the way government has attracted capital and created an environment which is very clear and transparent for foreign investors, and also very efficient in terms of execution of projects, approvals. Also, all those things are now, maybe last 2-3 years, we have seen even greater momentum. Road investment was going on, but railways were neglected. Now we see that railways they come on radar. Also, the domestic manufacturing industry and defense and many other industries for that matter. So I think it's a positive momentum that we have internal policies which are conducive. External environment is also becoming favorable.
Okay. And from a business point of view, what is looking so good?
So most of the business are good, but from our business point of view, so we are in a small ticket lending primarily for small businesses. So if you look at our microfinance for income generating activity, MSME business, and affordable home, all these are grossly underpenetrated in India. The credit market in India is much smaller compared to what it ought to be and what it is in comparable economies. And if you look at the growth of China and South Korea because they were maybe 1-2 decades ahead of India. And last 2 or 3 decades, the way they have grown, the credit market, that shows that India has a tremendous opportunity to grow. And if credit has to grow, then in India's financial system, there are only banks and NBFCs. They're regulated and they have to work hand in hand. And there are certain things which are, in a way, sometimes they're like railways and roads. In a way, banks can do certain things, they cannot do certain things. And NBFCs have some advantages, but they don't have, the access to the deposit franchise. So financial markets should do very well. There will be aberrations always, but if you ask me 5 years, 10 years, then our financial market, credit market, savings, investments, all of them will grow faster than the economy. They are leverage plays. So when the economy is growing at this pace, you'll see financial services growing faster.
Okay, coming specifically to the NBFC sector now, to your mind, what is the one big fillip for the NBFC sector as things stand today?
One is that I think our banks and NBFCs started working together in a very collaborative way. That is one. Two, most of the NBFCs now, they are large, established, and they can raise capital. So the threat to the system, which happened, say, in late 90s or, that kind of a situation is not there. Over the years, RBI has tightened the regulations in a manner that, I can't have a crystal ball, but it's very difficult for a big systemic problem because they're almost real-time monitoring the way most of the regulated entities are working. Technology is also helping government as well as regulators to monitor and regulate in a much better way. So many times in lending and financial business, one of the big threat is the unscrupulous players, probably causing a systemic issue. So that risk has been mitigated to a large extent. Can never be eliminated, but has been mitigated to a large extent. And as I said, the economy is doing well, so there's a demand for credit. So all these things are a big fillip for the sector. And as I said, that most of the surviving after the crisis of IIFL and COVID are well capitalized and well established and well run. So the sector has consolidated very well, and now players have a good track record and a good management team.
So I'm glad you brought up the unscrupulous people and then the RBI's more real-time monitoring. 2018 we had the IL&FS crisis. After that, 3 large NBFCs, DHFL, Shrey, Reliance Capital, all of them had their problems. How has the RBI's viewpoint changed in terms of NBFCs? Because what we learn is that, yes, they were very strict till now, but now they're starting to see a little bit light of the end of the tunnel type of situation. I'm talking about the RBI's viewpoint on the
RBI. I think they are continuously learning and becoming more and more vigilant. And so what happened in these cases is very different from the way things were operating. But still, if you really look at it, that despite these, there was no systemic issue. It is not something which really threatened the confidence of lenders, deposit holders. And some stray incidences will keep happening. You really can't, in a way, like, when people talk about road, there are always accidents every day, but you really can't stop the road transport. So there can be smaller, but as long as they make sure that the larger and systemic players are under control, you won't have a systemic issue. And so and RBI has now started using technology also a lot, and that is also, becoming, the Aadhaar, where every borrower's identity is unique and cannot be fudged or cannot be defrauded.
Yeah.
Now the account aggregator, OK, and all these protocols also make the data very easy to procure as well as monitor and analyze. So all these things are helping a lot. And I don't think that there is any laxity or any complacency as such. So wherever the norms have become stringent, they're stringent, and they keep getting tougher and tougher. So, like saying, your NPA recognition norm from 180 days to 90 days, your capital adequacy or your, how do you recognize your NPA? All those things have become, so they're getting closer and closer to the way banks are regulated.
Yeah. So that was going to be my next question, because I want to focus a little bit about the RBI's method of regulating the NBFC industry, which is to now have a tiered structure of regulation. Certain NBFCs because of their size, get treated a certain way. Smaller NBFCs get treated with slightly easier regulations. Having said that, for a large NBFC in the current market, is there any, we've seen what happened with HDFC Bank, but is there still regulatory arbitrage to continue as an NBFC, or graduating to a bank makes more sense?
No, banks also have arbitrage in a way, because the risk weightage for most of the loan assets are lower. They have deposit franchise. So there are pros and cons. In a way, NBFCs don't have obligation to do the priority sector and maintain certain CRR, SLR, but they don't have access to RBI as a lender of last resort. They don't have access to deposit. And some arbitrage is there, but not in a different way. Like, some of the banks have NBFCs, but later RBI, for last maybe couple of decades at least, has been of the view that either have NBFC or banks, you can't have both the things.
Correct.
But then they should have a sunset clause and make it,
the transition
similar, because you can't continue. Like, for instance, some of the NBFCs are taking deposit. They continue to take fresh deposit, but they are not giving any new license for deposit to NBFCs. So if they are not giving new license, regardless of the balance sheet strength, pedigree or credibility of the NBFC, then there should be a sunset. Why should they allow to take the earlier NBFC's fresh deposit? So I think there is a certain arbitrage, because when they change the policy, instead of giving a sunset or a certain time period for the existing players they give them infinite time. So to that extent, there is a not level playing field. But it's not a major thing to my mind. It's not something which is really sort of a game changer. But I would think that they should try and sort it out. But other than that, I think NBFCs have a different role to play. I'll tell you what is maybe in a very simplistic way how it is. So NBFCs basically will get their money from banks and other sources that are institutional primarily, and to a smaller extent public. They can raise money from foreign sources also. But the primary advantage is in lending, because in a smaller location, why we are a more efficient co-lending partner with banks also. In a smaller location, if I can have a 5-people branch only for one product, say gold loan or microfinance, and my cost of running that branch may be a lakh or a couple of lakh rupees in the month. But if you open a bank branch and people want to deposit cash, they want to withdraw cash, you can't have a 3 or 4 people branch, because that will be because banks, the moment is the bank, people would expect you to do basic banking services.
Correct.
So your cost goes up 10 times. Now your cost goes up 10 times, that area has a potential for, say, not more than 5 crore rupees of loan assets. Then banks won't survive, because they won't be able to cover their cost, regardless of RBI says that you go to underpenetrated areas, but then it's to be viable. Otherwise it becomes a hugely loss-making proposition for them.
Yeah.
And that's why, even despite so much of course public sector banks are there, but many public sector banks in these areas, they become only deposit mobilizing banks. They are not really geared to lend, because they don't have the will or infrastructure also. So even if you look at the largest public sector banks, their lending in top 10 cities is significantly more in terms of proportion as compared to deposit.
Correct.
So they are mobilizing deposit from smaller places and lending in larger cities. NBFCs are doing the reverse and maybe complementing banks in that way, that they're lending in smaller places and they're mobilizing money to a wholesale money from larger cities.
Fair enough. I want to tackle one more sort of industry question and then come to IIFL. The RBI governor in the recent monetary policy speech was very specific to point out, now it's rare that he dedicates one paragraph to certain parts of any kind of business, but he says something about unsecured lending, and he says that the risk is emanating. Now, since then, there have been multiple reports. He said certain parts of retail, but everybody understood as unsecured. I get it. Reports have come out after that saying under 50,000. Some of the banks have also pointed out under 50,000 is where the stress is. As a lender working in the small ticket, business in the market, what is your view? Do you think that this is a system-wide problem? This is a very small pocket problem? What exactly is happening?
Now, this is my view.
Yeah.
And so I may be a little biased because
Sure.
we are on NBFC, but I'm just trying to be very candid on this.
Sure.
So number of fintechs got funded by private equity at a valuation which are like driven by technology-led valuations. And more so when the private money was like pouring in, private equity. So, they basically are under pressure in a way because they give projections that we can grow our credit business at this speed, and that is why we are valued so much. So you are valuing, say, existing NBFCs, the incumbent player at X, you value us at 5x or 10x because we can grow at 10 times the pace.
Yeah.
And that is where the problems start, because lending is not something where you can just press the pedal. It's not something where, whatever technology, we also use as much technology and cutting edge technology, and many processes of ours are far better than many of the fintechs also, that you can really have something in lab which basically helps you do a better job. It's more experience, more and most all the regulated entities basically build up their credit underwriting, credit policy and risk management departments over a period of time. So many of these fintechs, so there's a fraud there to some extent. And then what happens that many of these fintechs can tie with so many NBFCs, and there are so many fintechs, and if they are all targeting those small customers, so if I am a borrower, I can take it from you, I can take it from him and pay you, and it can go on for some time. But ultimately, I may be borrowing more than what my capacity is. And sometimes maybe good people, because there are so many people approach them, they think, it's like, take loan. We are just instant loan, 1-click loan, 5-second loan. People nobody is dying to take 10-second loan. Let it take 1 day, 2 days. Yeah. But it's like, it's sold in that manner. And sometimes you'll see the father is putting money in SBI fixed deposit at 6%. Son is borrowing personal loan at 20% or credit card at 36%. And in between, everybody else is making money. So that kind of situation is there.
Yeah.
But what happens when you talk about unsecured lending? Our country is so large, number of customers are so many. So SBI is doing it a different way, NBFC is doing it a different way, some large NBFCs are doing it a different way, and smaller fintechs are doing it a different way. Some of them may be doing it a better way, so you can't really paint everybody with one brush. But largely, in my perception, many of these smaller fintechs who are under tremendous pressure to grow, because that's what they're committed to their private equity investors, they are creating the fraud. But the larger players, larger NBFCs and larger banks, in my view, for them, first of all, unsecured lending is a small part of their business, and even their underwriting processes are far better.
Fair enough. India has always been viewed as a country of savers, and what we saw recently, the RBI data was for FY23, net financial savings. I'm not talking about all. Financial savings have come down. In a country like India, or with a group of people like Indians who don't have a long history of going out and borrowing a lot of money, right, from people, then Indians are a little shy when it comes to borrowing money. But in a country like that, is it essential that access to loans should be so easy?
Now, this is a very interesting question. So, like what I learned from my father and grandfather and everybody, that be conservative and don't borrow.
Yeah.
And but when you really understand the way economies have grown world over, there will be some risk. As I say that, if you have a vehicle on the road, there will be accident, right? But nobody says that you stop the vehicles and avoid 300 people dying every day. So the way it works is, if you if you borrow, you can consume more, you can produce more if you have small businesses. So at the bottom of the pyramid, the credit will allow you to produce more and consume more, because your income levels go up, so you consume more. So what is happening is that the savings basically, when you consume, it comes into the system and it has a velocity. On the whole, I would say on the whole, it will let the economy grow faster.
Okay.
But there will be some people who will be negatively impacted because they are either not prudent or they are careless, or they get into on the wrong side of the cycle. So suppose you borrowed and you lose your job, obviously there will be bigger problem. Somebody can make an anecdotal evidences of, anecdotes of those and say, "Arey, this is what has happened. Look at this guy who borrowed and committed suicide, or this guy who borrowed and his house got sold." But people, if you go and really do a survey, you go and ask 1,000 people, then many of them will say, "Okay, I've grown my business. I have so much more income. With this, I have bought this." And similarly about stock market investing also. See what happens, there are, maybe 20 million investors, 10 million investors, so many of them would have made money. But they will, no newspaper or nobody, they are not newsworthy. They are not, they don't create sensation.
Correct.
But if somebody has lost money and something negative has happened, that will catch the eye of the regulators as well as media. So I think that is where countries like USA have done very well, because they've grown with a complete capitalism. And they have said that, okay, there's a risk and we are open. And if you see last 60, 70, 7 decades, the growth has been driven by that, and there is always risk. So I think it's a view, if you really want to take a pragmatic view, which is contrary to what our earlier generations have. And our earlier generations were right, because India was a relatively poor country. Your risk appetite was lower. We are a closed country. Yeah. We did not have access to capital from outside. But, I think if you allow the money to flow in, the larger segment, the base of the pyramid, will produce more, consume more, spend more, borrow more, and obviously, this cycle.
Fair enough. Let me come to IIFL and the story there. You are a relatively new entrant in the gold financing business. We've had NBFC that have been there for decades on end. Some of them have grown, some of them not done so well. Banks have, during COVID, they were allowed entry with a lower barrier, so they went gung-ho. Now they're slowing down. To your mind, why gold loan? Why did you want to take that business up?
So we have been there now for 13, 14 years, 13 years or 14 years kind of a thing. So say from 2010-11 we got into the business, right? The larger players, they are decades, but till 2007-8 they were very small. Yeah. So they hadn't scaled up the business. Yeah. So in a way, the learning curve disadvantage is not as much as it is perceived from outside. Yeah. Because by the time they started scaling up, we came maybe 3-4 years later. Correct. So if you go back, 20-30 years, they were very small local players with hardly any assets. So it's not that they've been there for 3 decades or 4 decades. So that is one. Yeah. Secondly, in India, gold is a very, very special product and a good, most like 70-80% of our gold loan customers would be small businesses. And, when everybody talks about MSME, I'll give you some insight into it, that why people don't really understand what MSME is and why credit delivery is still poor. So there are, I think, about 85 million MSMEs as per Niti Aayog or this thing. Out of, I think, 99.6% are micro and their working capital requirement will be less than 1 or 2 lakh rupees. So say 50,000 rupees, 1 lakh rupees, 2 lakh rupees. That's the segment nobody caters to. So people can say we are doing MSME loans, 50 crores is also MSME loan, 5,000 rupees also MSME loan. So the problem with the language is that one word is trying to capture so much that is not doing justice.
Correct.
And there's a long tail of MSME which nobody is catering to. So many of these businesses that borrow on gold because it's so convenient for them. Now there's a Diwali, they need more working capital. If there's a sudden spike because the business is going to go, they need to borrow quickly. There's a gold, you take the money, you give the gold, your money is back. Somebody suddenly needs some money for education, for health, for medical. They really don't have to go and, because still the unsecured loan, as you know, as you just mentioned, that this country still will be conservative, will be cautious. The small things go wrong, everybody will just pounce on this.
Correct. From
the media to regulators, they, see what has happened. So I think gold is a very convenient because people borrow at a relatively better terms, on relatively better, lower cost. And, compared to say pawnbrokers, still they have a huge market.
Yeah.
And which there are very opaque practices and sometimes, exorbitant rate of interest and everything. And now, I think your second question was that banks and competition had come in this. I think to my mind, this is again my perception, but so banks, one problem that, we must understand is that the smaller gold loans, our average ticket size is 50,000-60,000 rupees, will be median gold loan size. On that, and that may be typically 3 or 4 months. So our operating cost, even if we run at a fairly good scale, is almost around 6-7% of loan asset is our operating expense.
Okay.
So suppose I am borrowing at 9%, 7% is operating cost, it becomes 16. Now, if as a bank I have to be optically right and lend at 7.5%, 8%, it becomes difficult. Otherwise, what will happen? For a bank, if I must say bank branch manager, I can give a loan of 1 crore, 5 crore, 10 crores. With this 50,000 rupees, it will take very long time for me to meet the target. I won't meet the target.
Correct.
So when there are smaller banks, they are more working like gold loan companies also. But there's a different breed of banks. They are very small in balance sheet, small in operating cost, and many times to the customer, the cost of borrowing from bank may be more expensive. Now you'll say, why? Also interesting. Many of the banks will charge 1,200 or 1,600 rupees as a valuation because they get value from outside.
Correct.
If I'm borrowing 50,000 rupees and paying back in 1 month's time or 2 months' time, it will be horrendous for me.
Yeah.
So there are many intricacies in this, and that's why NBFCs have a niche in which they are viable and they do a good job. They are very flexible because see what happens, people are very emotional about their gold. They give the money, they want their gold back in 10 minutes.
Yeah.
Many people are shopkeepers who have left their shop and come. They can't wait there for half an hour, come next day. And many of the banks are there that, okay, you leave your gold, they get it valued. But still, I don't know whether you know this, that banks have gold loans. Like the largest bank will have gold loan much bigger than 4 times the largest NBFC in gold loan. So still, supposing I am not in a hurry, then I know that gold loan from SBI is very cheap. And if I want to borrow for a year or whatever, I'll go to SBI, if it's a reasonable amount. But if it's a small loan for a few months, then it doesn't make any difference for me to pay a higher cost.
Correct.
So still banks are getting large part of gold loan, but gold loan is a big market in this country.
Fair enough. Lending to the small businessman or the small entrepreneur in this country for a very long period of time, as you said, that there's MSME is a very wide term and it doesn't really capture every business out there. But banks have had this sort of hand-wavy approach for the smaller guys. You're too risky for me, I'm not going to touch you. And probably they would end up with either NBFCs or money lenders who probably, lead to the financial
actually,
growth.
their problem is that suppose you have to collect a 500 rupees or 1,000 rupees check, it's very unviable for banks.
For a bank, yeah.
It will be very expensive.
Makes sense.
So it makes sense for them to get into partnership.
For you? Why does it make sense for you to do that business?
Because as I said that we can have a lean mean setup. So I can have a local branch getting to a small town or a small local area with 5 people, 6 people, with younger people. Some of them may be like those Amazon delivery boys who can go and do this. Banks can't hire these kind of people. They can't have these small branches. So it's very different way in which we work.
So now they're coming to you for co-lending.
So, we are partnering.
Yes.
I can't say they're coming to us or we are going to them, but it makes sense for both of us, so then we do that.
But what has that opened up for a lender like yourself, opportunity-wise?
It's a tremendous opportunity for us as well as banks, because most of the priority sector assets where banks fall short of, because that we can help them to, and for us also because we don't have a deposit franchise, so we don't get access to a reliable source of capital which is continuously flowing the way banks have. Then co-lending is, from a ALM point of view, is also very convenient. From a capital point of view also is very easy. So it makes sense for us.
You've recently gone to the market to raise money. That was in July, if I'm not wrong, which is when you tapped the NCD market. I wanted to understand from you in terms of your overall scheme of borrowing, or how you are approaching borrowing in a high interest rate market. Do you want to depend on these bond market, or is that the only option at this point in time, or will other sort of opportunities open up?
No, there's only a small part of our total borrowing program, but we borrow from banks, we borrow from insurance companies, we borrow from multilateral and foreign currency loans also from external agencies. So we borrow from all the sources.
Yeah. And
very recently, and because we do, we lend out to socially weaker sector.
Yeah.
Sometimes we are able to get a credit, money at a much lower cost of capital.
The reason I'm bringing this up is because, as I said in the beginning of the interview, the cost of funds have significantly gone up. So for you to maintain that kind of high margin business, obviously you'll have to pass it on to the customer, right? I mean, or are you not passing it on?
No, it gets passed on mostly, and most of our small customers are relatively insensitive to, as I said, that the increase in interest cost as a percentage of what you are paying was 10 to 20 and not 50 or 100 as it is there in developed countries, or where it has gone up 4 times, 5 times. So we pass it on, and if the economy is doing well, income levels are growing, people are willing to take it. If things go bad in terms of macro, where the GDP or the economy slows down significantly, people start losing jobs, or the business slows down and not growing well, that's the time you have a problem.
Okay, I'm going to start wrapping this up, but I wanted to also get an idea from you as to what the future of IIFL Group and finance specifically is looking like. As a lender, do you want to continue being the small ticket? Is this the business that you want to completely establish yourself in?
So we want to be a small ticket lender. The retail lending market in India is already 90 lakh crores.
Correct.
So whatever pace it grows, even if the economy grows at 7-8%, and with inflation, your money supply or nominal income grows by 12-13%, with whatever velocity, you'll have faster growth in M3. So I think there's a huge market that is there. So we remain focused on small ticket. We remain focused on loans to customer segments and geographical areas where banking penetration still is weaker. So I think there's a sweet spot that we have, and we see a tremendous trajectory for growth. So there's no reason for us to deviate or sort of move away from there.
I want to take the last question of this chat with you. What is the one threat that you think everybody's missing out?
Political and geopolitical both.
But that's every time I turn on the TV, I can see it right there.
No, I think world in terms of stability, peace, and balance is very precarious, much more than at least in our living times. And also the developed market economies are also grossly leveraged. The US, how long they can sustain this, we don't know. But most of the economists, they have been fearing that one day we don't know that day can be tomorrow, or can be 10 years later or 50 years later. But there is so the larger economies are leveraged, and the developed economies, and the growth is slowing down. How it will impact the whole world, we don't know. Geopolitical tension is much worse than and higher than ever before. So I think how they're going to impact is very difficult to
estimate.
So India may be in a sweet spot, but can't be completely unscathed if there's a global disaster.
Correct.
So that is something which people will have to take into account.
Fair enough. Thank you so much, Mr. Jain, for joining us on the conversation. Pleasure talking to you, sir.